Coming up, the yen weakens despite a Bank of Japan interest rate rise, and the market's on hold ahead of a US interest rates decision later tonight. That's all coming up. It is your daily 10-minute business and finance news wrap for this Wednesday, the 20th of March 2024. Later on Market Day, we'll speak with Francesco Stradis from Ord Minnett for all the day's market action. But first, to the Japanese yen, which has weakened despite the Bank of Japan lifting interest rates for the first time in 17 years yesterday to 0.1%, ending a period of negative interest rates. What it means is that the Australian dollar remains at a near 10-year high against the Japanese currency, making it a more attractive tourist destination for Aussies. For more, I spoke with the head of research at Pepperstone, Chris Weston.
Well, this is a yen move more than anything else. And I think the Bank of Japan should be applauded for the communication with the market. I mean, this was such a well-telegraphed event that we were going to see changes to their policy stance, that the market's not been shocked in any capacity at all. I mean, it's an incredible move that they've actually, for the first time since 2007, moved away from negative rates and actually lifted rates. But the market had anticipated this to the extent, but also the Bank of Japan are still going to be buying bonds, which continues to see their balance sheet expand. And ultimately, they've not been shown any commitment to raising rates in the future. So there's still big divergence between policy settings between other central banks. So really what we've seen is a green light for currency traders to sell the yen, and the Australian dollar against the yen has pushed up to multi-year highs on the back of that, alongside other currencies like the US dollar and the Norwegian crown. All these currencies have won well against the Japanese yen. So this is a weaker yen effect more than anything else here.
Finally, speaking of Australia, does it go in part to explain why we've seen this surge in the number of Australians travelling to Japan when we see the currency at a near or about a 10-year high against the Japanese yen?
Well, I think it certainly helps, but I think it's now just starting to come home to roost. I mean, Australians are so used to going to America, and I think people come back and say, well, it's so expensive from a currency perspective, that maybe they start looking around other places. Of course, everyone wants to go to Japan. It's an amazing place to go anyway. But you are seeing momentum build now, and this is not just a currency effect. I mean, Japan are open, and you're seeing numbers around the world, moving into Japan, and the tourist numbers are ballooning. We're still some 80% from the levels that we saw pre-COVID, but they are very much on the increase now. So I think, if you're looking for that purchasing power on a holiday destination, then we're pretty much at the highest level since 2014 in Aussie yen. And my view is that the momentum is there for all to see, and I think we'll probably continue to appreciate against the yen. So, I think as we go into an Australian winter and you're looking for other places outside of Australia to come, I think the currency is only going to become a tailwind to increase that purchasing power going forward. So Japan is becoming cheaper from a purchasing power perspective to go into as destination. It's becoming ever more attractive as that holiday destination.
Chris Weston there from Pepperstone.
Now, Market Day on the SBS On the Money podcast.
Now, the Australian share market really was in a holding pattern today. The S&P ASX 200 are down just 0.1%, 7,695 in that holding pattern until the US Federal Reserve decision on interest rates, which will come out later tonight. For more on that and the day's market action, I spoke with Francesco Stradis, an investment advisor at Ord Minnett. Francesco, US interest rates firmly in focus. What do you think will come out of the meeting later tonight, and what will be the implication for markets?
Yeah, well, we saw the Reserve Bank of Australia sit on their hands yesterday and not change anything with the official cash rate. And I think what we'll see in the US is pretty much the same. The cash rate over there is about 5.5%. The key to all the interest rates, though, is inflation. I think their inflation rate's up around the 3.2, and their target rate is 2%. So they're still well above that target rate for inflation. So I think they'll remain at 5.5% on a restrictionary basis for interest rates. You also got to consider that we're in an election year in the United States, and Governments tend to spend a bit of money, so the fiscal stance will be expansionary. So I think they have to maintain some sort of contractionary stance on interest rates.
How does this play into the global interest rate story? Because we've also got the Bank of England later tonight. As you mentioned, the Reserve Bank left interest rates on hold yesterday. The Bank of Japan really the outlier there, ending its negative interest rate policy by lifting interest rates for the first time in 17 years, although rates are still at 0 to 0.1%. So it's at that zero level. How does this all play into it? Because isn't the theme we're kind of waiting to find out when interest rates will be cut?
Yes. Well, I think expectations, and part of the reason the equities market over the last couple of months has been so strong is that they're anticipating over the next 12 to 18 months that rates will start to come off a bit because the markets like to be a little bit ahead of itself, I suppose. But on the interest rate front, I think the key to it is where is the neutral stance? And obviously each country is going to have a different number for, I suppose, neutral monetary policy. I think in Australia, we're about 3.8, but I think the key to it is the relativity of it all. I mean, you mentioned the Bank of Japan, they're at 0.1% on interest rates at the moment. That's where we came from, 6, 12 months ago. So they're still very contractionary in Japan. And ultimately, if they've gone from 0 to 0.1, the currency effect is going to be negligible. I think what we have to see there is rates get up to at least 1 to 1.5% before any currency impact it has on the Australian dollar compared to the Japanese. I think the neutral stance on Japan is around 2%. So they've got a long way to go on the upside to become neutral. And most developed countries around the world, like the United States, Australia, and Europe and the United Kingdom, have a little way to come back a bit. But I'm probably not anticipating rate cuts until the latter half of this year, maybe August, September.
Okay, I know the market, everyone's pretty much sitting on the sidelines, so there hasn't been much of a move on the Australian share market, but run us through where you've seen any interesting moves though.
Yeah, well, the market started relatively strong, a little bit stronger in the morning, and it's just come back to about neutral the last I looked. So, it's paring back all its gains, I think probably because the anticipation of that rate or lack of a rate move in the US is going to come to fruition. Energy stocks are stronger, but we've seen the oil price rise about 5% over the last 5 trading days. And your large oil and gas stocks like Woodside and Santos are up about the same. Other areas of strength in the market, the banks are a little bit stronger, not much, and other resources stocks like your big miners. I think that's more of a flight to safety rather than any movement in, I suppose, subjectivity of the market, if you like. So today, energy stocks, I think, probably are the ones that are keeping our head above water.
And finally, where do you see the opportunities for investors at the moment?
Well, you look at the equity markets at the moment, and everyone would have the same opinion that they're overvalued. The Australian market, is trading on about 16 to 17 times earnings. Long-term average is around 14.5 times earnings. So slightly overvalued. I wouldn't panic about that. But, I would expect the market to sort of have a bit of a reality check over the next couple of months. But that doesn't mean there aren't opportunities out there. I think there are a couple of areas. I think the healthcare stocks, the likes of ResMed and CSL, have been treated harshly over the last 6 to 12 months. I still think there's good value there. The likes of BHP and Rio are trading on fairly attractive multiples. I think the expectations of the Chinese stimulus not being enough might have pulled those share prices back a bit. So I think there's value there. Along with Min Resources, we're expecting to see some significant growth in their earnings over the next 12 to 18 months, and significant growth, I mean, almost double in their earnings. And other areas, I think Endeavour Drinks has been, sold off quite heavily enough, and I think there's some value there as well.
Francesco Stradis there from Ord Minnett. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.